Hey everyone, welcome. My name is Ronsley, and we're joined at the Bitcoin forecast with Willy Woo. And we have Brad Mills. If you have any questions, use the chat, put it in the chat, and we'll get to them. Willy, how's it going?
Good. Thanks for that, Ronsley. Yeah, thanks for joining us, everybody. This is the first public kind of call that we've made that you can, everyone can join from YouTube. So we've been running this series. It's it's going to be a 3-week series of 2 live calls per week for subscribers to the newsletter. The idea is really to recreate that kind of hedge fund weekly call environment. Just looking at the markets and analyzing it. So we want to just open that up to the subscribers, give retail access to that same sort of experience. So the live chat is there for any questions you may have. And I'll just take the first 15 minutes to cover the markets very, very quickly. So those that just want the coverage of the markets can just take that and kind of leave the call, and the rest will be opening the floor to questions. And we have Brad Mills patching in at 3 a.m. in Canada to co-host this. He'll be taking some of the questions in the chat room, but I think that's about it really. So I'll just get started and share a screen right this minute. And who's got the ability to give me share screen control?
That
great.
would be now. Yep.
That'll work for me. Now I just need to make sure I've got the right one, which is that one. Okay, I'm going to go from macro through to micro, or the most like short-term price action. So this is the long-term holder supply shock, which most of you should be familiar with. It's a ratio of coins that have not moved in the last 5 months versus the ones that have moved. So this stuff in deep cold storage tends to not move anytime soon. And so the probability of that moving just drops off a cliff as a sea change. So we can use that as a ratio. And what you find are these oscillations. So whenever I'm at the top end of this this chart here, the purple line, it's the long-term holder is at peak. And so generally when we're in this zone, you've got peak accumulation, and these guys tend to sell down in the rallies. You saw that in this last rally from October last year. And when they run out of ammo, the short-term holders hold those coins. So generally in the new sort of weak hands investors. So when we're in this zone here, where the market's often a bit soft, you'll find bear markets start when this is in the lower band. So we're up in the strong area that has been selling down, meaning that they have instigated taking profits. If you go back 5 months, it's really in this zone here and prior. So structurally, this is quite bullish. Like the strong-handed guys have a lot of ammo. I don't see any kind of bear market when you zoom out on this picture, because we're in this zone here. It's typically a zone of strength. So like depending on how long this starts to drop down into these lower regions, will give us kind of a timing picture, a signature on how long our bullish phase of the market will run for. A lot of people have been saying, typically end of a 4-year cycle, we come to an end around this time of December. We've got tax season coming soon. But it just turns out that instead of being in a low zone here, like the 2017 top, we're in a very structurally strong area. So I'm expecting this run to continue, and maybe it goes into midway of 2022, who knows? Maybe this chops around a lot, yet to be seen. But long-term, it's structurally bullish. I think a lot of, I'll get to the shorter time frame stuff later, like a lot of people fearing that we may go into a bear market. And certainly the earlier chart doesn't show that that's set up for it. But like this chart is a new one I've been working on, and it's really a extension of some prior stuff I've been doing. It's looking at the flow of coins between hodlers. Um, like there's a category of hodlers that you can see on chain that I've been terming the Rick Astleys. They buy and they buy for every 4 coins that move into or out of their wallets. 3 of them are in and 1 are out. So and that's the minimum bar to be a hodler. So generally these guys are strong holders, and this is the heat map. It runs over, I think it's around 50 days, moving. So this is like the number of coins moving into hodler wallets over the 50 days or not. And then you can draw this kind of heat map that shows where we are in the macro. And, you know, we have a very strong phase running up to this sort of April, May period where it weakened in May, and then a lot of divestment from the hodlers that led to our bearish phase here. And that's been on recovery, and there's a little bit of softening, which has led up to this liquidity crunch we had over the weekend. But it's still in it's not like in a red zone, it's softened. I'm not expecting this to capitulate anytime soon. In fact, we may see this strengthen, but we can keep an eye on it. It's sort of in that mid zone where like maybe we're here or here or here. And maybe it pivots the other way, but it'll take some time for this to go red. And this is the graph view of it. So the net flows are towards hodlers currently. It's not crossed to the bearish phase here below the 0 line where they're leaving hodlers. Another sort of macro-ish indicator is all through this dip. The little guys have been buying, retail have been buying, people who have less than 1 Bitcoin in all their accumulated addresses that we can see on chain. This is the flow of coins moving into their wallets each day. So 867 Bitcoins were bought by the retail people in the last day collectively. And so, and then if I were to turn on the heat map here, this is tracking whales and dolphins, people with 100 Bitcoins upwards, whales being 1,000 Bitcoins upwards. So significant buying happening in here amongst the selling. It doesn't look all like this kind of red, you know, populated by red, where the rich started to divest at this top end. You know, the rich, I think, being more of the institutional funds starting to divest and booking out their profits when they bought in this zone here. So going into the shorter time frame view, this is the same sort of chart I showed earlier, except this is on a daily. And again, we're looking at the coins moving in and out of hodler wallets. Also, I've superimposed exchange flows, so I can turn them on and off. So together, it kind of builds this picture, like flows coming out of exchanges, flows out of you know, the exchanges where you can buy or sell, that's much more liquid, into something illiquid like cold storage. So solid buying right now in this dip. So really, overall, the market is buying this dip. There's support. I don't think we're about to cliff, even though technically you look at the charts and you know, we had a decent pullback. And if you zoom out, it doesn't look strong having done that. But the fundamental spot picture looks good. And also we can cover this whole crash down I covered last time. It was from flushing out the long positions in the futures markets, and so those guys are out now, and so it's really hard to have a liquidity crunch downwards. If anything, it would be to take out the shorts, but the open interest number of contracts that are betting on it going down are nowhere near the number of contracts that were betting on it going upwards that caused this kind of flash crash. Also, it was a weekend, and also it was like December is a soft month for institutions. They're booking out their profits. They're probably only going to really enter with strength come the next year. So it's just a soft time in the market for liquidity. So it did lead to an exaggerated move downwards as that leverage got flushed out of the system. And this again, taking a view of taking the hodlers as demand and people who aren't hodlers as supply. The hodlers are like, the amount of coins they hold, it's like those coins you aren't going to be able to buy, and the coins that the rest hold, that maybe you can buy them. So it's the ratio of that, and that produces a kind of demand and supply intent. And that's what the green line is. And so we were going kind of sideways. It was kind of soft. And the thing to look for was whether or not this flash crash in price would shake out the hodlers and get scared. They get scared. And we saw it recovering. So it's another visualization of that heat map I showed earlier with the buying the dip. They are buying the dip. The red line is changing kind of where we categorize it to, to put more emphasis on seeing where what the speculators are doing as well, the swing traders. So they're not selling off. They sold off here. This is kind of more the speculative swing trader that may buy coins, hold them for a number of months, and then divest. So that kind of accumulating. They dumped out before this collapse. So overall, the shorter time frame picture looked steady. I would say this is more setting up for a recovery, soft kind of consolidation. It's not looking at this stage like massive mooning of this green line, which would support breaking an all-time high. I think December is going to be soft leading into January, where we might have a bit more money coming into the system. But I don't see a bear market in sight. Now, if we were to look at that green line, if you look at that green line, it shows you the demand and supply on chain. We can take a look back on it and say, look, we're currently in a zone here. We can look up the price and we say, the price was 50,000, say, and we're currently here it was 55-ish. So you can do kind of this look back of similar regions of demand and supply and get a price. And this is what this model does. And it's really saying from that demand and supply seen on chain, this is the price. The red dotted line is where we are at in similar situations. So the market is currently under pricing, like what the demand and supply is fundamentally, and the market being traders on exchanges. And so generally you don't get a dip below the red line for very often. It did it in COVID, and it was a wide gap, and it came back and recovered. Generally you see it around the same or above. And so we're in a buy the dip under this model, and buy the dip zone under this model. And like if I turn this on for those, have a look, see that those are the look backs of price hesitations. So yep, we should be up in the, looking at this, we should be in the $55,000 to $60,000 range based on on-chain demand supply. By the way, all of this stuff uses Glass Nodes data. It's their liquid supply, and it's been pre-processed before going into these models, because they actually drift a lot just from the way that metric is derived. So it's corrected for the drift before we throw it into all of the stuff I'm showing you here. So yeah, that's the same chart. We covered that before. This is now going into the shortest time frames, and I'm looking at similarly demand and supply on the exchanges, looking at like the leading exchanges, looking at who's buying and trying to ascertain what kind of people are buying. And I tweeted out that this was a bottom here, and and what happened was we got a bounce. We did get a bounce, but it started to weave downwards again, and that led up to this, that weakening led up to this like pullback here. So it's made another V. So the short time frame stuff says, we're recovering possibly, but it's still really hard to tell whether or not this has carved a total like global bottom here. A local bottom has happened, but not a global. I'm tentatively thinking it's we're good for a V-shaped recovery right now. I think even the last two updates in the letter, I've said like a V-shaped recovery looks more probable, and we're still on track with that. This is a heat map of the bids on Binance and the offers here. So we've got a decent amount of support under here, and like kind of, you can get past this zone here, there's a liquidity gap up to here before all those offers are on. This is just bullshit, you know. This is probably one person, they laid it all up. Often this kind of spoofing happens for price control. So and it works very well, and you can kind of see what happened here. We went a whole bunch of bids were stacked here, bounced us up, and then those bids were removed and offers were put, which pretty much a scare wall, which opened the way for this liquidity crunch. So that's a game that's been played on the exchanges, and that was done at a very particular time. It's weekend, very low liquidity on the exchanges, and high. We had high open interest, like a lot of contracts that were able to be liquidated, and they were. And this is another view of the low time frame stuff. This is another way of measuring derivatives markets. This is tracking this is a Glassnode's annualized basis. It's effectively, you know, it's like kind of like the cash and carry yield, but in simple terms, it tracks what the futures, quarterly calendar futures prices versus the spot price, and that premium we call contango expands or contracts depending on how much long demand there is in the market. Turns out the sophisticated traders use this instrument more than retail because it is cheaper to use this instrument, and so the sophisticated traders tend to trade better, and so you can use this as a leading signal. Like this bounced up in a very sharp recovery before the price did, because after these contracts got liquidated, the smart guys came in and scooped it up. So like particularly in this zone here, we had a price pullback downwards whilst the contracts were being bought up and the premium expanding. So that was a good sign. That's a good sign even right now. The price is pulling back, yet the contango is increasing, basis is increasing. It's like, it's most likely that price will come and obey what the sophisticated traders are doing, which are buying these long contracts. Some of this might even be coming from the futures-based ETF, because you know it goes to the CME and it gets arbitraged across all of the exchanges. So that's the market summary. It looks like a recovery is on its way. No sign of a bear market or a capitulation further down. So I wouldn't say it's like a FOMO buy the dip on leverage kind of thing. I think it's just don't get shaken out, and you know, certainly I'd be careful, but most of the signs from macro down to the micro is of recovery. Okay, that's the 15 minutes, maybe even 20. Shall we open the floor for questions, Brad?
Yeah, sure. There's quite a few questions in there. Also should probably mention, since this is a new channel, people should probably subscribe to this Willy Woo channel. Yugan Axie, sorry, I can't pronounce. Some of these names are difficult to pronounce, but that user says, do you have any thoughts on stablecoin supply ratio in Bollinger Bands? They say that it looks like there's a big volatile move imminent. Do you think it's an up or down movement?
SSR. Let me find that chart. Let me see if I can. Stablecoin ratio, right? Stablecoin ratio. Let me just see if we've got, if that's working. We're going to pull that up. Okay. Is that here we go. Loading. Let's get to the zone we're looking at. So that's what it looks like currently. The red line, then you run standard deviation bands, so Bollinger bands, bring it into an oscillator view. And so certainly not down in this zone where it's a, super bullish, like super bullish. These zones where it's low, it's like you're in that extreme oversold two stable coins. The stable coin supply is very, very large against the market cap of Bitcoin. We're now in a not overheated zone, but I don't see much signal coming from this other than it's in a more bullish zone than a bearish zone, or a more oversold zone rather than overbought zone, because sometimes you want to be in overbought zone for a long time as this thing runs. So I mean, that's what it looks like, but I have no comments. It's not like a chart that I'd be talking about right now, because it doesn't tell us much. And look, we're in a squeeze of there, so it's I don't know what that actually means when we're in a squeeze of Bollinger Bands. Maybe it's like this when we're in a squeeze. It moves upwards because we're in an area of stability. But yeah, that's the stable coin ratio.
Cool. So the next question is from Jay Singh. He says, the Bitcoin supply shock valuation model looks really good, but it would be great if the subscription gave access to a site where we could check charts like this with the latest data. Have you thought about something like that?
Well, for starters, access to that is an $800 subscription to Glassnode. It uses their top tier data. So I don't have the ability to share that live. I have the license to include it in the letter, and I have the license to tweet the odd snapshot referencing them. As far as I know, no one else has, but they do it anyway. But I'm also post-processing it, right? Which is not being done by Glassnode. So I can't actually post-process it on Glassnode's workbench. So that's the supply shock that you'd get using their workbench. This is the supply shock I get by correcting for the drift. So I have no ability to do that, but I'm pretty tight with them, and we're thinking about maybe moving the letter onto their platform and really making some of these charts live, and the ability to even subscribe to them as a Glassnode member or some sort of hybrid membership. So it's in the talks. It's not coming anytime soon as in the next month. It takes a lot of engineering to get this kind of stuff done at scale with Glassnode, and they're super obviously busy with immense amounts of growth happening on that platform. So yeah, we know that it's wanted and it makes sense, but we'll see. We'll figure out how to do it, but it might not be anytime soon.
Makes sense. All right. So next question, a viewer by the name of Now I Think You Know You're Wrong says, if you backtest the whale behavior, do you think that they make more return over regular hodlers?
No, I don't see them. I see them selling the bottoms often. I see a lot of bad trading by whales, but they do impact. Sometimes they make good trades, sometimes they make bad trades. But I will show you when there's a sustained move by whales. It's let's see if I can find it. When there's a sustained move by whales, it is reliable in what they do, as a cohort, because often you see a little bit of maybe you can find, so this one entity, let's turn off the dolphins there, right? And so Like, look, a lot of whale selling that dump right there. Pretty nasty point to sell. Um, and other times that guy got it right. And then some, maybe he took some profit. Maybe it's another whale selling. Um, that guy. So it's not always clear cut. But if you correct for all of the, maybe I'll call it the topography of the industry, and you don't use just addresses, you use the entities data that like people like Glassnode, I think, also Chainalysis have that kind of stuff, which I don't think they've released their product. I think they've got an analysis product. But like when you start to forensically track these guys, like not addresses, but the cluster of addresses, and then you filter out the guys that are miners, you take out Satoshi's coins, you take out GBTC, which is a huge amount of supply, and you take out the corporate holdings and the exchanges. And the green line is actually what you get. The green line is the holdings by whales. Individual whales, or maybe a hedge fund or whatever. But like you see, they sell down, they continually sell down. People think whales get richer and richer and they suck all the coins. They're not. They're getting rid of their coins and the supply is diversifying. Meanwhile, the shrimps are coming up and scooping up the coins. Meanwhile, the publicly held Bitcoins, either on exchanges for hundreds of millions of people or held with shareholding in public companies, or even ETFs, that like combined, the holdings, public holdings of retail is more than the whales. But you'll see that the whales do accumulate against this distribution over certain times here, before and during that rally, here in the 10K band, and just recently in the zone here. So the whales as a cohort have been accumulating. That's a bullish sign. Like a mid macro, they generally, like here, they bought here as well in that zone, and they rode this all the way up. And as it was running, they were divesting and taking their profits. So we just had that event happening now, and as it's running, they're starting to go back to the divesting behavior. Because why not? You probably bought your coins back here for like $100 or $10, like Brad or Max Kaiser, who bought for $1, I think, or less. So those guys are divesting.
Yeah, that's actually really interesting to watch that, to see that maybe they're not the smartest traders, but they will support the price if they've got a lot of confidence in Bitcoin long term, and they're not trying to sell to just, maybe they're only going to sell like 5% of their stack or something like that. They'll pause their selling, or they'll even switch to buying when the market looks like it needs their help.
Yeah. And like, you got to think about this in their shoes as well. And that, like, if you're a whale, it means a minimum 1,000 Bitcoins, right? So that's $50 million, like, or 60 million. And so if you're just your average whale, it's not even a minimum whale, you're worth over 100 million, maybe you're worth 500 million, and it's all stuck in Bitcoin, and it's getting pretty volatile, and you're probably going to divest out of that and just diversify. You might buy a few toys, you might buy an island, you might buy like, I don't know, a politician, which I think is starting to happen these days. There's a lot of lobbying power now with the money that can be bought with crypto.
Well, there was a couple questions in the chat as well about that. Do you have any specific kind of like thoughts on the outcome of that hearing today, where all the CEOs of the different cryptocurrencies and exchanges had to go to the Congress, or went to Congress and testified?
I didn't actually watch it. It's I haven't had a chance to watch that yet, but it sounds like it's pretty positive, right? But I've got no nuance view into that side of things. But yeah, I only saw the meme videos like Sherman reading from his script to pump Mongoose Coin. To me, it just sounded like his script writer was playing a joke on him, and he had scooped up Mongoose Coin or something, or hamster coin. But
That was last time. He did the hamster coin last time. It pumped like 1,000%, and this time he did mongoose coin.
Like his script writers are making a lot of money off him. He probably doesn't. We should like really he should be like I don't know who's involved is it for regulating these markets, commodity markets. He should be like put under trial for pumping these coins.
Yeah, really. I guess it was for crypto, not really Bitcoin. It wasn't really relevant for anything to do with Bitcoin. It was relevant for crypto because they're going there trying to make the case for why this stuff shouldn't be overregulated, but they all are in compliance. Like the sentiment was that they want to see regulations, they want to comply with KYC, surveillance, all that stuff. And it was definitely a lot less adversarial as the Hillary Clinton sort of take on it was. Like today the summary was mostly just like everybody wants to be in compliance, and there was no adversarial stuff going on. So I think that's why people think it was bullish, because they weren't saying like we're gonna shut you down. It was Brad Sherman being grumpy was the only
It's
real
a
negative.
really interesting time right now because politicians have they have a job to do, which is to represent the public, and the public now are getting exposure to these assets at a ridiculously increasingly fast rate. Some surveys are saying up to 20% of Americans have exposure to the crypto asset class, right? And I just know doing the numbers, it's like this stuff doubles every year. And so we've passed that early adopter phase and we're in that exponential growth into the middle, 50% of the population having exposure. So I don't know how much the population have exposure to equities, but it's getting that kind of numbers now. And if the regulators shut that down, politicians have got to answer to the people. They're going to lose a lot of wealth, and I think it's going to get to a point where I think it's beyond the point where you can just it's money laundering and dirty practices and just create that narrative and shut it all down. It's going to wreak havoc. And if you're going to try and shut it all down, you've got to do it. If it takes a year, and then what, 30-40% of Americans have exposure by then, I think it's too late. They've got to really take a sensible approach now. And there'll be pandemonium. Crypto's gotten too big to just simply create a narrative. And really, it's bad for your political career, right? You're just spinning shit about this industry you know nothing of, and the American public have a better idea than you. Well, they can see through the FUD. Yeah.
Well, a lot of Bitcoiners have gotten behind this new candidate, Annika Rhodes, who's like a pro Bitcoin person going up against Brad Sherman. So I think he might lose his job to Bitcoiners because they're really supporting her, and she's not like totally opposite of what he's doing.
Yeah, I could totally see it's a political hot topic, and it will be more so. A lot of people voted Trump in because he was good for business. He was good for the equities market. So that's going to happen with crypto as well. It's a political force more and more, and it's growing very, very quickly. Does anyone have more questions regarding market?
Yeah. So we've got Freaky Tech says, Willy, if we have less and less BTC on exchanges, does it mean that the volatility will increase in the future instead of slowly dropping?
You'd think so, right? Because the supply starts to dry out, and the upward volatility could go upwards quite substantially. Because it's hard to So you get the classic supply shock, the shock of not having coins. So in theory, yes, but it's already gone up because more so because we've got futures and options markets that are highly, well, the futures markets are highly liquid and even getting more liquid as we develop this ecosystem. And the kind of flash crash we saw, the kind of flash crash we saw just over the weekend is a sign of that kind of volatility. I think we all understand that now. I don't think that it's as simple as just that. I think it's more that the way in which the ecosystem works now is very different than it did 3 years ago. And these exotic derivatives instruments, exotic for what we're used to, right? We're used to spot trading Bitcoin back in the day. Now we've got the full on stuff that we see happening, not stuff, but the same sort of instruments being created that you see in regular financial markets. And so, you can see that here, right? Like there's a lot of open value, a lot of Bitcoin denominated open value. This is like 388,000 Bitcoin valued contracts. So that's people taking bets. The price is going to go up or down over that number of Bitcoins, almost 400,000 Bitcoins. And someone's going to be wrong. And when one side is proven wrong, they're forced to sell because they get liquidated or their stop losses kick in, and you have a cascade of stop losses kicking in, and the thing, all the contracts resolve, and we're now like they buy back and those contracts disappear. And so you see it, that we saw it here with this crash down from our highs. So this is the main drive volatility now for Bitcoin. And where's my volatility chart? Bitcoin volatility. Here's the volatility against other assets, but there it is. It's just, I just wanted to put light to just the long-term effect that it has. This is like Bitcoin's 60-day volatility. And I'll just bring that chart over. And you'll see, if you ignore this zone here, it was trending downwards, 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 right? And then, of course, there's a bull market, so we have upward volatility. But do you notice that there was a migration back up or against that trend? There was a very strong trend downwards in volatility. And then now we've popped out and we haven't reduced much. BitMEX launched around here and got substantial volume by here. The CME launched around here too. So now you've got futures markets long shorting this thing, and you would have noticed if you zoomed into the price action here, the price of Bitcoin started to bar upwards and downwards and chop around all over, and the volatility increased. So that's the introduction of a futures market onto the volatility of Bitcoin. It shifted that trend that was going downwards back to a step upwards. And now we've got a futures ETF, which is adding more and more volume to the futures market. So there's more of these exotic instruments that are being laid on top that's causing more volatility. It's a little bit like the banking system, you get these kind of flash crashes because there's all these exotic instruments like options, futures, CDOs, synthetic CDOs. We saw that with the banking, with the subprime market. So that's probably got more influence on volatility than just the supply being sucked off. It's cool. That's like organic. That's kind of organic. This is like synthetic volatility. Like this is like nuclear weapons, and unless we disarm it, we do some disarming, which we kind of did. We went from 150x down to 20x, I think. Like we'll have we'll continue to see ways in which volatility can be injected into the system. And not all of it's bad, because when you get this kind of volatility, it creates a lot of opportunity for market neutral operators to run arbitrage between this huge spreads that you start to see as volatility opens up, and it just allows people to get higher yields. So, a lot of people, meaning traditional funds, are coming in and market making this stuff and running arb to generate, 15 to 40% per annum yield on the US dollar, when the traditional markets are only offering like 2 to 5% at best. So it's that in itself brings more people into the space. Like, just about everything's good for Bitcoin right now. Okay.
So a couple of we'll go into the Ethereum stuff, because quite a few people are asking about that. We got a bunch of other questions not related to that, but let's do that because people are wanting to know your thoughts. Peter Lee says, what are your thoughts on ETH BTC ratio being this high? It's not been this pretty much the top of the last market. Do you think it's correlated at all? Do you think maybe it's a cycle top? Or and then lots of other people asking just your thoughts. Do you think it's going to keep going?
Yeah, I think it's going to keep going. I think that people don't really understand just how much effectively supply shock is being created into Ethereum's network because of the EIP 1559. Effectively, they're burning a portion of their mined coins. It's not mine coins, it's just transaction processing. The miners take a cut, but then they burn a bunch of it, and it's only been $4 billion of Ethereum burnt since they launched that a few months ago. And put that in perspective, it's way more than MicroStrategy bought of Bitcoin on a smaller market cap coin. So if you think about that, that's a ridiculous upward price pressure on that. And and it's great if, like, they made the decision, in my view, is to bolster number go up and start to push towards store of value properties at the detriment of the smart contracts app ecosystem, because a lot of those guys are struggling, and a lot of those guys are bailing to other competing L1 networks. It's yet to be seen whether or not the L2, layer twos, that kind of makes it a lot cheaper again, whether they will be sufficient to stem the tide of people leaving the ecosystem. But that's the choice that Ethereum has taken, really, to let's tax the DeFi app ecosystem to push number go up. We've yet to see whether that's sustainable. But if L2 is successful and gets the fees down, that means L1 gets less fees, and therefore you get less burn, and the whole thing will just find its equilibrium again. But probably a sort of a next step upwards in its equilibrium. So I wouldn't be surprised if the ETH BTC valuation, or where it sort of mean reverts around, will be higher than in the past because of that protocol change. So yeah, I can have a look at, let's have a look at the ETH BTC. Oh, come on, go. Right, let's turn off some noise. Like, this is kind of the ratio of the supply shocks that we see on chain between Bitcoin and Ethereum. This is the ETH BTC price. So that's that's what it looks like. The supply shock on Ethereum is climbing against Bitcoins over time, and the price is tracking that in a much more haphazard way. But this is what the fundamental demand as a ratio of the two coins are. the Ethereum demand is climbing in excess of the demand of Bitcoin. So a lot of this valuation you see with Ethereum is it's supported by fundamentals. It's not, you know, overbought or anything. Against the US dollar, it looks like this, right? It's just up, you know. When this pumped up without this going up, it pulled back and it found its balance again. And so we're well in the all-time highs. We're in the same, let's say this was an anomaly. It was like a exit pump before they dumped it. The whales, I imagine. It was like, I don't know what caused that, but someone in the ecosystem will know.
That was the Ethereum Foundation actually selling the top.
No, but I want to know what caused that pump, because it was absolutely nothing supporting it fundamentally.
Oh, the pump.
The pump before the dump. Maybe the foundation orchestrated a pump before they sold the dump. But you know, like whales often.
I think that was peak Dogecoin, all that stuff. I think that was just peak. Everything was going crazy around.
Oh, okay.
Around
So it was the end of the alt cycle. But if you were to compare where we are here to say, like, you know, like anyway, we can look at this. You can say that this fundamental is very, very strong, and the price is probably on the low side of where the fundamentals are pointing. So it's not a bad trade, you know. Ethereum's not a bad trade. Again, I don't hodl Ethereum. All my Ethereum sits on exchange because I spot rotate in and out of altcoins, but I don't see any point in cold storage, and I don't stake the stuff. Never been much of an Ethereum hodler, but that's also my, you know, view on. I only want to hodl monetary assets that I believe in. Even, geez, you know, I only cold storage. I only use cold storage as a bearer asset if the whole freaking system implodes, and you know, it's like a doomsday event, and you've got a little bit of Bitcoin in a wallet that you can carry with you, and like the institutions can't stop you, you know, the government can't stop you. I mean, that's the real need for hodling. Everything else I put to work, you know, I'm either trading it or I've deployed into hedge funds or stuff like that. So, well, that's my view anyway. For Ethereum, I'll hold it until I don't hold it, and I'll sell it, and I'll keep it on the exchange.
Do you see any, James asks, do you see the on-chain signals for Bitcoin dominance? Is it relevant at all? Do you measure across different blockchains?
So what was the question again? Dominance is a technical indicator. What's that got to do with blockchains?
So I guess what he's saying is there any on-chain signals for, so like, I think me and you talked about this a little while ago. If you could, I think where he's going with this is, could you predict or see whales moving across from Bitcoin to then like whale addresses lowering on the Bitcoin chart and then whale addresses increasing on the Ethereum chart, to see like whales moving around on chain to predict dominance?
That probably wouldn't be something I could do. It's something that a, you know, low level data aggregator can do. Plan B might be able to do if he was interested, but I don't. He only does Bitcoin. But yeah, you might be able to do that with Ethereum. You know, the lower cap coins and the newer coins are very hard to get any kind of signal out of because they're not organic. You just, you know, you could see, oh, there's people buying here. Oh, wait, that guy that owned 3% of the supply just decided to dump 1%, and you'll never see it coming until it happens, you know. So it's very inorganic, and it's weird shit happening, and they have, like, when you start to do this analysis, like shitcoins are like completely, their charts are quite manipulated. If you look at like Bitcoin's charts being manipulated by the strength of a few whales putting some scare walls on a derivative exchange, bouncing the thing around. Imagine what you can do when you own like maybe 5% of the supply as a whale in a shitcoin. So I don't even bother with that anymore. I used to have a lot of that data using Coinmetrics stuff, but it's very hard to build any kind of signal that makes sense because there was no organicness. I'm sure you could probably find signals if you spend enough time, but every every network has a different protocol, and it's an inordinate amount of work to get that data in and process it and figure out signals for low cap coins aren't going to carry much capital. So generally, I just do technical analysis for altcoins. Yeah, you'd have
What
to
do you
be a
think
diehard.
in general? Do you put much weight on the dominance indicator or whatever? Like, do you follow that, or do you feel
I
like
like
that's
it.
just
I really like it. I actually trade with it because
do you?
it does help. Like you can run RSI on it, you can run, TD sequential, you can run technical indicators on it to look for likely probabilities of reversals or trend exhaustion. Things can only go one way for long enough. So you can sort of overlay that stuff, it kind of obeys the fibs. So yeah, you can, it's useful as a technical.
It's just like it's designed in a weird way. For me, I used to look at it more. Now I just find that it's only ever gonna be at they have stable coins in there. They have like wrapped Bitcoin. They have ETH on other chains. There's never gonna be a low pressure, of more things adding to the decline of Bitcoin dominance, because it's like even BSV has billions of dollars of market cap. You know what I mean? Like, how relevant do you think it is over long time frames as like tens of thousands of more coins get added to the whole chart, and like the market cap of all that stuff is much lower quality than the market cap of, say, Bitcoin.
Yeah, it is not a good indicator of if you're going to view it as a market and of value across that market, it's market cap's not actually value stored. And those numbers skew a lot. So I mean, I'll throw up realized like where are we? Kind of like. Maybe I'll just do this one here, like the orange line. See the orange line on this? Orange line is the amount of money stored in Bitcoin, and so on average, we paid $24,500 per coin. So multiply that by the number of coins. That's how much money was planted inside Bitcoin, and you see sometimes we drop below the amount of money that it stores. But generally we're above it. But if you were to do this with other coins, their prices are way higher because a lot of their coins are staked and locked up, and you get these much higher multipliers over what was actually paid for the coin. So you get that kind of skewed, and then you multiply it by 8,000 coins. And then you see that like it looks like very little of it's Bitcoin, but actually most of the actual capital being stored is Bitcoin.
So Marcel says, what do you think about the Bitcoin dominance being where it is right now? Because in the past, when it's been this low, it means it's near a top.
I wouldn't use it as a top indicator. It might be a top for altcoins, but like it doesn't even seem like that either. So I wouldn't use it for anything like that, and I wouldn't use it to look at the history and go, oh, this was a top in 2017, because 2021 is completely different. So yeah, I don't think it's useful for finding tops.
Good answers. Short, concise. There's a couple questions about the macro correlation. What do you think about you've talked before about the difference between there's going to be a parabolic blow off top. Ivor Lynn has asked if you think that there's going to be a parabolic phase, or do you think that there's like a macroeconomic shift that could take Bitcoin into a bear market? Just kind of your general thoughts about the future
Yeah,
of the Bitcoin market and how it ties to macro.
I don't think we'll get a parabolic blow off top. And I think we're like we saw with this rounded top here is a sign of things to come, because the market's very sophisticated now. You don't really see blow off tops in equities. You see it in penny stocks. You'll see it in altcoins. You'll see it in Bitcoin when it was very young. But now it's much more sophisticated. A lot of money to be done taking the short side as well when it gets overheated. So I think we'll get more rounded tops. It will start to look more like the larger markets, like the equities markets moving forward. I'm not thinking I think all these predictions of 400,000, they're contingent of a blow off top. Like this top model here, you seem to hit it on a blow off top. And so that target right now is in the 210,000. But I'm not sure if we're going to get a blow off top anymore. I'm looking at this kind of stuff, and this, I mean, the FOMO in here was comparable to the FOMO in here, right? We were around, we saw it. And then we got a rounded top as the big guy started to dump and divest over a distribution top. Ruffer started selling. There was a number of people selling. We saw a lot of red dots in the whale tracking heat map. And I think that's a sign of things to come.
Yeah, that was also one of the biggest challenges Bitcoin's ever faced in its history was the China Bitcoin ban. So it did shake a lot of people's confidence.
Yeah,
except for Willy Woo. Willy Woo was still confident.
Yeah, it was a very patient kind of sideways reaccumulation, wasn't it? It took ages. Any more kind of market questions before we close up?
Yeah, so let's see. There's one question about what would you need? Andrew Wimster asked, what would it take for you to reduce your position at this point? There's lots of people asking that general question about it seems like there's people that are thinking, is it gonna stop? Is the bull market gonna stop? And how do they tell? And what would you do?
I'm not you, right? Everyone has their own strategy and their own risk tolerance and their own ability to act with short timing. And so you should always take a long-term view, and you should always have a plan that suits you. What I do is really specific to my job is really looking at the markets all the time. So when I see bearish phases, I'll sell immediately, because it's a big chunk is my trade account on exchanges, and so I move to cash, and the rest I let ride, because that's my sovereign stack. And then I'm constantly taking profits to cash, and then I'm putting into cash yield and other investments. So I try to keep a very sort of specific portfolio, always a minimum of 10% in cash. And I said last time, that cash is for IQ protection. Like in a down market, you want to retain your sanity and your ability to think. And when you have zero cash, when the thing's crashing, you tend to lose it. And you probably find that your IQ drops, and you won't be able to have a rational decision at the bottom. It'll be emotional. So I always keep 10% in cash. The amount of exposure I have will vary depending on, the price action regime, and it swings massive. Like I could be like here, I was very much leveraged, and then I went to cash around here, around the time I sent out that we're going into multi-months of bear around there. I went to cash. People sometimes think I sold the top there because they think I'm some sort of legend or something, but no, it took a while for the on-chain to go, yeah, this is screwed, and I sold to cash, but that was just my exchange account. And so that's my plan. And if we start to enter any kind of phase that looks like long-term topish, I might move my cash positioning to 15%. When I say cash positioning, I mean not the cash sitting on exchange that can go back into Bitcoin at a drop of a hat. I mean, like this is going and being deployed into that cash instrument that's generating a yield, that hedge fund, this or that. So that stuff's much, they're kind of on a monthly schedule that the windows are open to put money into those kind of instruments. So that's my plan. It's not like the 2017 plan. The 2017 plan was ride this up and not trying to time the top. Wait for this dead cat bounce. Whenever it crashes, there's always one bounce. Wait for the dead cat bounce and then look at the market structure. And the market structure here was bearish because the volume had dropped away from the blockchain. So that was my plan, which I executed. I sold around 12,000, 11 to 12,000. It wasn't the 20,000, but at least I didn't sell here, trying to time the like 10,000 top. There's a lot of people thought 10,000 was the top. I didn't sell the 7,000. I just said, I'm not going to try and time it. I need a solid signal. And then I sold all of it. And then I waited till here, into this zone here, I accumulated. So, I mean, just have a plan that suits you. Like, and I think I was the only one that was trading NVT at the time. So that was a signal that was more likely to work because no one else was like looking at it. Now I'm more measured. I'm just going to diversify and keep cash. And my view of it is that we're entering the last cycle, meaning this is going to do a drunken wander upwards like this and not look like your 4-year parabolic. Like, the vertical reds are the halvenings, and we have like that kind of 1, 2, and then everyone's expecting a 3 and a 4. I'm going, no, I think it's drunken walk all the way up till we reach the million or the 10 million or whatever the saturation point gets to. And so that just takes a different strategy for me.
Bitcoin Tina likes to say that he thinks Bitcoin is going to bore us to $1 million. It's kind of a similar way of saying what you say.
Bitcoin's starting to get pretty boring for me. I'm like thinking of like, spinning up other projects now and not so much the analysis side. I want to do, I'm doing more around the like the delta neutral, the market neutral trades, being involved in funds that are working on that kind of stuff. And so, yeah, I think it's a good summary.
And that's good. With that, we probably like 3BD asked, do you think we would see an 80% drop in the bear market? And I guess that's a good question to follow on this. If we're going to be bored on the way up to 1 million and a drunken walk up, it's probably going to be less volatile on the crashes or in the bear markets.
Well, we've seen that the 50% pullback is that we just saw here. That was a 50%, really, 60 to 30, a bit more than 60%. Similarly here in COVID flash crash, right? And again here, 6,000 to 3,000. So I think that that's starting to show as a 50% seems to be where the liquidity is found in a liquidation event. All of the pullbacks to date have been liquidations. Thank you, futures contracts. So it's not spot sell-offs. And so it's even a different mechanism. And so that seems like a nice one. I could see it being I could see it being an 80 to 85% pullback in a total liquidity failure. But in that case, I'd expect it to spike up pretty quick. It probably 50% is the long-term daily draw down. 85% might be in a wick if like some exchanges completely shit themselves. But yeah. Certainly not. I think the main thing is not the drawdown, but how long does it take to recover? Like, should it take this over 1 year, like we saw here and here, or is it like 3 or 4 months? So I don't think we'll see the 1 year recoveries and pullbacks.
Awesome. Well, we're at time here, so I don't know if we want to probably encourage people to like the or subscribe to the channel. Willie, do you think you're going to continue doing them on the YouTube channel or back to Zoom? A couple people have commented in the chat here that they like it on YouTube.
Yeah, like this is all experimental. It's a one-time thing. Like it's meant to be a private channel for this call. And I mean, my hopes is really more for the, solid questions about what the market is doing rather than making it about me or what I'm doing for my investments. So it's really to create that really like this week's market events, and we're just going to cover that just like if we were in a hedge fund. And this one's made public because we do want to get one out publicly, because one of the things I want to do is take the 15-minute call, do them like 2 times a week, maybe even more, and then give us a fast cadence to cover even the shorter time frame stuff. And then now that it's public, I want to invite people to take that 15 minutes and transcribe it into a few short sentences that can go out to subscribers. So we can read one paragraph. It will take you 60 seconds. You don't have to sit for an hour for any kind of YouTube video for that. It's just people who value their time, instead of listening to me talk about my opinions on altcoins and market caps and Bitcoin versus shitcoins. And so I don't want to get away from that. I want to make it succinct. And so this is just a one-time experiment to put it out there so people know this is out there, and also even for us to develop the product. We will be inviting people to have a shot at transcribing the first 15 minutes into like a 1 minute paragraph that can be read. And if you're up for it, there's a job waiting for you on the other end of that, in partnership with Glassnode, because we want to turn this into something that's, workable for a broader set of audience than what the current leader is set up for.
All righty.
Amazing.
Okay, well, thanks for joining us, everyone. Appreciate the questions, and yeah, just watch the space. We'll figure out what we'll do with this next.
Yeah. So just while we're winding this up, thanks, Willie. Thanks, Brad. That was great. Thank you, everyone that was in the chat. And if you just subscribe to the channel, you'll know when the next one goes live and whenever the next one goes public. So Willie will sort of send out a newsletter for the next subscriber one, which is next week. Look out for that. Otherwise, all right, team, we'll see you next week.
Sounds great. Thanks, Ron. Thanks,
Cheers.
Brad.